We're working through Chapter 15 related questions, and now we come to number 5. And number 5 gives us a look at if we could move income legitimately from a parent to a child's tax return, what kind of impact would that have? So it says a sole proprietor in the 37% tax bracket pays her 16-year-old son a reasonable salary of $14,000 for services performed for the proprietorship. Compute the family's tax savings if the son has no other income and takes a $12,550 standard deduction. Right, so we're not going to get into the probably what the main debate would be is one is that reasonable salary, and probably did the son really do anything for the proprietorship? We're going to assume all of that's correct, that the son actually did do work for the proprietorship, and that $14,000 is considered reasonable for what they did. So we're going to look at it from two sides then. How is it going to save money? Well, for the sole proprietorship, that's the Schedule C. So if you kind of think about it, how would the Schedule C look like without this and with this? With this, we're going to say the Schedule C is going to get $14,000 additional deduction, right? So that's a deduction on the Schedule C tax return. So it's reducing our Schedule C income, which is thus reducing our total income and our adjusted gross income and down to taxable income. So it works its way down to a $14,000 decrease to taxable income. So if we were being taxed at the 37% tax rate, right, we would say $14,000 times 37%, or $5,180. That's tax savings on the parent's return, right? So we'll even label that savings on parents. So then the other side though is the child does need to file a tax return. So on that return, they had $14,000. It says that's all they had. It mentions they're taking a $12,550 standard deduction. So if we do that subtraction there, we get $1,450 in taxable income. If you look that up in the tax table, he is in the 10% tax bracket. So tax on the child would be $145, right? So tax on child. So the overall savings then is going to be we saved $5,180 on the parents, but we paid $145 on the child's return. So the $5,180 minus the $145 equals a tax savings of $5,035, right? So this is family tax savings. So the answer would be A. And I like that because it shows us if you can make a change, that it can make a difference. Okay, so number 6 here talks about Mr. and Mrs. Williams are the sole shareholders of Lesson Inc., a regular corporation. Last year, Lesson employed the Williams son and paid him a $50,000 salary. During a recent IRS audit, the revenue agent discovered the son rarely shows up for work and spends most of his time playing golf. Which of the following statements is true? So I don't know what it is about every time I read this. First thing that comes in mind is when it says rarely shows up for work and spends most of the time playing golf, the son is obviously the managing partner of a tax firm, right? Because they would argue they're out marketing a lot. But we're going to assume that's not what the accurate answer is. What has happened is what I warned up here that we assumed was just correct, that the son actually did do work and the $14,000 was reasonable. So what happens when that's proven not to be the case? That this is really just something to move income. So let's look at the options here, because it may be a combination of things. So the IRS can treat the $50,000 payment as a constructive dividend to the son. Right? And again, we're looking for a true statement. So they're not really concerned about the son, right? The son getting the dividend, right? Son's not doing anything, right? So son would not be the person getting a dividend, right? Because they're not a shareholder, correct? So that's not going to pan out. That's not what they're really wanting to see. B says the IRS can treat the $50,000 payment as a constructive dividend to Mr. and Mrs. Williams. So you may or may not have studied this. A constructive dividend is like, even though it wasn't in the form of a check, it's still the same thing as the shareholders getting money out of the company through the form of a dividend. Right, so that is true. That's one of the things that can be true. That's not the answer. We're going to see it's going to be down below where it combines some things. But before we go into that, so why is it, you can say, well, so what? They're just calling it a dividend to Mr. and Mrs. Williams, right? But there's a key difference, isn't it? Remember, dividends come out of equity. So what does that mean? No tax deduction for it. So what they try to do is get a salary because they got the deduction. If it gets reclassified as a dividend, then that's not a deduction on the tax return. C says the IRS can disallow less than $50,000 deductions for the son's salary. And I've already given it away probably, but that's the combination of those two things in D is what's going to happen, that the IRS can treat the $50,000 payment as a constructive dividend to Mr. and Mrs. Williams and disallow the $50,000 deduction for the son's salary. Right, so it's really both of those things because they're going to increase the income of the company. Right, so now what has the company not done? They've not paid taxes, so there's going to be taxes to pay. They're not going to think highly of this approach, so there's going to be some interest to pay. Well, interest because you took some time to pay it. And there's probably going to be some noticeable penalties applied. So many things can happen. That's why you need to be careful with these salaries. And they get more and more attention, especially when you're talking about what they call related parties. So owners to company to owners or company to owner kids, things of that nature. They want to make sure that those are legitimate deductions. But that's what could happen and has happened when things are tried to be deducted that aren't really business.